This video is for anyone that has questions about the mortgage industry, specifically interest rates. All right, what's up, everybody? This is David Green, co-host of the Bigger Pockets podcast, author of Long Distance Real Estate Investing, Buy, Rehab, Refinance, Repeat, the Burr book, as well as Sold, the book I wrote for real estate agents. Now, there's going to be a sequel to that coming out soon. So if you're a real estate agent, please subscribe to this channel because we're going to be having more content coming out to help you do better at your job and make more money. Now, I also own a mortgage company, and I did that because I got tired of lenders not doing a good job, and then me as the agent would have to go in there and clean up their mess for them. I've learned a ton about the mortgage industry, and I want to share with you whether you're looking to buy a property yourself, you're an investor like me, or you're a real estate agent who wants to help your clients also like me. But the more knowledge that you have about how lending works, how financing works, the better of a job you can do. Because I'm going to tell you one of the huge secrets that people who own a lot of real estate understand is that it's not always about the property. A lot of time it's about the financing. And if you can get the financing right, you can make deals work that you otherwise couldn't. Now, this video is not going to be about a super secret special squirrel technique that no one else knows about that you can make a bunch of money with. It's actually going to be a rock solid fundamental that I just want to make sure you understand. So I'm going to give you an app to download. Take a minute to get your phones ready if you're not listening to this on your phone, because you're going to need to download an app. Okay, before we move on with the video, I want you to go to the App Store and download an app called Mortgage Calculator Plus. If you have a different mortgage calculator on your phone, that's fine. You can use that. I'm just telling you the one that I like and we're going to use on the video. Now, a few things I want you to understand about how mortgages work in general. The first thing is, if we're talking about a mortgage you're getting on a house, a 30-year fixed rate Fannie Mae, Freddie Mac product, what almost everyone you know use to buy most of their first houses. The loan is amortized over a period of time, which is usually 30 years. Amortization is a fancy word that means you make a payment that includes principal and interest every single month. Now, that payment stays fixed. A portion of that payment that goes towards paying down the loan starts off very small, and with every payment gets a little bit bigger. And the portion of that payment that goes towards interest, meaning you lose it, the bank keeps it, starts off big and over time gets smaller. This is one of the reasons that owning real estate builds you wealth over time. And it's because the financing component is set up to be more expensive for you in the beginning and cheaper for you in the end. Okay, now when calculating your payment, there's a couple things that are going to go into it. Things like taxes and homeowners insurance, and taxes are different for different properties, maybe an HOA payment. We're not going to talk about that today. We're just talking about the mortgage, which is made up of principal and interest. Now, there's two components that go in determining what that payment's going to be. The first is the amount of money that you borrowed from the bank or the lender, whoever it is, and the next is the interest rate. Now, I'm bringing this up because owning a mortgage company and working as a lender, people are very sensitive about rate. You hear this all the time. What's my rate? What's my rate? Can you beat their rate? This is a good rate. Is this a good rate? Can you do it cheaper than them? What if they're going to charge me this much? How much are you going to charge me? It's rate all the time. Now, first off, there's other things than rate to consider. Sometimes banks will give you a really low rate because they know you're excited and they're going to charge you more in closing costs to make up for it, and you never know it. Other times, banks offer a really cheap rate that they use to pull you in, and then their service is terrible. You don't close on time, you lose the house. This happens way more often than you think. People just don't talk about it. What am I getting at? It's not always best to get the low rate, but low rates are better than high rates. So let's talk about how valuable is the lower rate. Is it worth possibly losing the deal, having to start all over, working with a person you don't really trust just because their rate is better? Now, as of today, most of our clients that are buying a primary residence are getting a rate somewhere between 3% and 3.25. That fluctuates all the time. So depending on when you're watching this video, that's probably not where rates are today. But here's the point I want to illustrate. The difference between a 3% rate and a 3.5% rate, what does that actually impact on the final payment? Point number one to take from this: the more money you borrow, the more impactful the interest rate is. So we're going to take a look at two examples. One of them is going to be borrowing a bigger amount, and one of them is going to be borrowing a smaller amount so that you can get an idea how much the amount you are going to borrow will impact your total overall payment. Then we're going to look at the difference in the actual rate. So with a fixed cost that you're going to be borrowing, a fixed amount, I'm borrowing X amount of money. If we play with the rate between 3% and 3.5, what does that actually do? Then I'm going to draw an illustration to show you when it really matters, when you should be looking at interest rate, and when it's less important, so that we're putting our proper attention and effort towards interest rate at the times when it means the most. Okay, let's break out Mortgage Calculator Plus and play with this a little bit. By the way, if you guys want to reach out to me for financing, you want to buy a house, you have questions about real estate, you can look us up. We're called The One Brokerage. The fastest way would be just to hit me up on social media. I'm David Green 24. You can also email loans@thebrokersca.com. That's the email that we use for this company, or you can message me. I'll get you connected to the right person. All right, we're going to start with somebody who's buying a $300,000 house and putting 5% down. Okay, so we put in $300,000 for the home price. We put a down payment of 5%. What that means is we are going to be borrowing, or we're going to be putting down $15,000. So we're going to be borrowing $285. Okay, it should look something like this. What you're borrowing, what you're putting down, and what your interest rate actually is would be in the last column. Now I can see the principal and interest on this property that I bought for $300,000, putting down 5%, borrowing $285. The principal and interest is $1,280. So let me write that down. Now, let's say that I have to pay a 3.5 instead of a 3.0. Maybe my credit was a little bit higher than I thought. Maybe my lender wasn't quite as cheap as the other lender. Maybe I went with this lender because someone said, hey, they can close in 14 days, and your realtor used that to actually get you the property. And your lender jumped on the phone with your agent and helped lock up that deal that you won over 7 other buyers. This is going to set you up for the rest of your life as a great deal. But you're getting buyer's remorse because someone said, oh, my lender will do it for 3%, but you're at 3.5. At 3.5, that exact same loan has a principal and interest payment. If you were to get the 3% instead of the 3.5, your payment would actually be $1,202. Now, comparing that to the $1,280, that is a difference of $78. Now, I'm not here to try to say $78 isn't a lot of money, but I would like you to put that into context. I've literally seen people that walked away from deals over that 0.5%. In this example, $78 is something that most people could make working one shift at a coffee house if they had to. No one's losing their house over $78. And it's not like the payment went from $200 to $278. It went from $1,202 to $1,280. It's not a huge swing. And that's what I want to highlight. When you're not borrowing a ton of money, the higher rate doesn't affect you nearly as much. Now let's look at this same example, but instead of a $300,000 house, it's a $600,000 house. In this case, we're buying a $600,000 house. We're putting down 5%, which is 30 grand. So we're going to be borrowing 570, and the rate is 3.5. That makes our payment at $2,560. If we were to get that to a 3% instead, that brings us to a $2,403. If we take $2,560 minus $2,403, that's a difference of $157. Now, that's more than the 78 that we were talking about. We're actually up almost to 160 here. And the point is, that's because we're borrowing more money. The more money that you're borrowing, the more significant the interest rate becomes. That's the point I'm trying to highlight here. Now, we should also know interest rates are still relatively low. So the difference between that 300 and the 3.5, 0.5%, that's nothing to shake a stick at. That's a pretty big difference. Still only comes out to $157. This is on a $2,500 a month mortgage. It's probably not changing anything for anybody. And so what I'm trying to highlight is, don't just ask for a rate. Rate is not the most important only factor. It is a factor. All things being equal, yes, I want the lower rate compared to the higher rate. But here's what I've learned as a real estate investor. Rents are going up every single year. My return is increasing every single year. Not getting that house is the worst thing that could have happened to me. Getting the house at a higher rate than what I wanted to pay, I don't love it, but it really doesn't matter. Now, look, I'm talking about somebody who, when I started buying real estate, rates were in the 4.5 to 5% range. Many of my first mortgages were at 4.75, which we all thought was an incredibly good rate. Now that you're looking at 3.25, 3.25, that might not seem so good. It seems high. I made so much more money on those houses that I bought with the high rate than the people are making right now, because I bought that house 8 years ago. I've had 8 years of paying off the mortgage. I've had 8 years of more money going towards the principal than the interest on that property. I've had 8 years of rent increases. There's zero chance I would ever go back and say, well, I know rates are going to drop to 3.25, so I shouldn't buy right now. I would have bought those properties at 6, 7, 8%. It just wouldn't have mattered. That's what I want you guys to know. Getting the property is so much more important, and getting the right property than getting the best rate. I barely even bring up rate. I just say things like, is it in the 5s or the 6s? That's what I'm looking at when it comes to taking down a good deal. Another thing, rates often drop. So I've refinanced some of those 4.75% deals into much lower rates, and many of them I'm at 3.75 or 4.25. You can always refinance into a lower rate, but if you don't get an adjustable mortgage, you don't have to worry about rates going up. The game is rigged to help you win. And I know a lot of people don't like hearing that because they've lost money in real estate. I'm not saying you can't lose money. I'm saying the game is rigged. The way it is designed, if you play it the right way, to protect you so much more than it will hurt you. You're buying a house, the appraisal comes in low. Well, as the buyer, you can often back out with an appraisal contingency. Can the seller ask for more money? No, they can't. It's rigged to help the buyer. Same is true with interest rates. So I just want everyone to take a minute, take a deep breath, and think about that. Now, the last point that I want to make in this video is not just about what is your rate, it's also about how much should you put down. This one comes up all the time. Should I put more money down? David, I need to put more money down and make my house cheaper. I can't put 5% down. I'm going to save up to 20% or 15%. Then I'm going to buy a house. Okay, let's take a look at if that's actually a good decision. We've got the same $600,000 house, and at a 3.5% interest rate, our payment was $2,560. That's at 5% down. Now let's jump this up to 15% down. That changes our down payment from $30,000 to $90,000. Now, there's a few pieces I just want to point out before I move on with this video. The first thing, it's $60,000 more you got to put down. How much time does it take the average person to save $60,000? That could literally be 2 to 3 years of time spent saving. And what is happening to prices during that time? Prices are going to be going up a ton in most scenarios. You're also missing out on 2 to 3 years of rent increases because you waited to save up that money. So the question is the money that I save putting more down even getting me anywhere? First of all, prices might have gone up more than $60,000 that it took you to save that money. But also on a monthly payment perspective, am I saving enough money per month to save up the money to wait on buying? Let's just make this a math problem, not an emotion problem. So in this case, when you're putting down 15%, you're obviously borrowing less money. So your payment is dropping to $2,290. Let's look at the difference between those numbers. So we have $2,560 minus $2,290. That equals $270 a month. That's how much you saved by saving up $60,000 and putting it down. Now, one thing I'll point out is if you're buying a $600,000 house like we're talking about over 2 to 3 years, your rents could have increased more than $270. And so that money that you think you saved, you didn't even save because rents would have gone up. The other piece is the house probably appreciated faster than the money that you were able to save. Here's the point. When money is cheap, which it is right now, 3.5%, this would become even less significant at 3% if I left the number even lower. Okay. Wouldn't be a ton, but it would be a little bit. When money is cheap, putting more down doesn't help you. Doesn't help you nearly as much. It doesn't give you the safety that it thinks it's giving you. This is a perception of safety that is not rooted in reality. And I don't want any of you who are listening to this to get caught thinking putting 5% down is risky, but putting 15% down, that's much safer. The difference is $270, okay? And the opportunity cost of waiting to buy a house because you want to have more money to put down is usually much greater than the money you're saving. Now, to add another layer of complexity of this, as if I haven't beat this point home enough, is to say that extra $60,000 that you put down was 10% of the purchase price. So you were going to put down 5%, instead you put down 15%. You saved another 10%. That could be the down payment on a complete new property. So if $60,000 could get you a down payment on a vacation home, a $600,000 vacation home, that was going to make you a couple $100 a month. And instead of buying a whole home with it, you just put it into the home you're already buying and save $270 a month. Did you even win at all? Did you even come out on top? And you could have had 2 properties appreciating in value, appreciating in rent, appreciating in cash flow, and paying off the loan. Instead, you got 1 and you didn't even make any more money. Why am I bringing this up? Because when people get in the moment, when they get in the escrow, when they're at the moment where they have to make the commitment and go buy the house, their brain goes crazy and it thinks of all of these things that could go wrong, and you feel safer putting all your eggs into one basket. it's not always safer. I want you to take a step back, zoom out, see the big picture, and very rarely does it ever make sense to put more money down on a house. Now, let's talk about the one time where I might not be giving this advice. Any idea when that might be? If you guessed it's when rates are a lot higher, you were right. Let's take a look at this exact same example, but instead of rates in the 3 and 3.5% range, let's jump this up to if rates get up to 12%, okay? On a $600,000 house, 5% down, and a 12% interest rate, your payment is now $58.63. Whew, much higher than we're used to, okay? The difference at a 12% interest rate versus an 11% interest rate, maybe you might even be more of a spread than that, but that's what we're going to go with. 11% becomes $54.28. So the difference between $58.63 and $54.28 is $435, okay? So if we're looking at it 12%, 11% interest rates, now we're at $435 a month just for that extra 0.5%. Or let's look at what the difference would be if we didn't change the rate, if we left the rate at 12%, but we just put more down, okay? Now we're gonna put down 15% instead of 5%. At the 12% interest rate, we're going down to $52.46 from $58.63. Do some math on that. $58.63 minus $52.46. Now you're at $617. I might recommend that somebody saves up more money to put on one house in certain situations if rates are at 12%, and it's actually going to save you $600 plus to save up a little bit more, to save that same $60,000, okay? If that same $60,000 is making you whatever it was, $150 a month instead of $617, it probably doesn't make sense to put it towards the house, okay? Put your resources to where you get the best return. You're not getting a great return when rates are at 3%. You are getting a pretty good return when they're at 12%. I hope this brought a little bit of perspective into this age-old question of what's my rate? Many times it doesn't even matter.